Well, greetings, SIE test takers. This is Dean Tinney. I'm coming to you from my studio here in fabulous Las Vegas. The first month of each quarter, I teach a SIE open enrollment public class. And the second month of each quarter, I do an open enrollment Series 7 public class. And then third month of each quarter, last month in each quarter, I teach an open enrollment 65, 66 class. And I use those classes next week, Tuesday, as the SIE class, as a prod, if you will, in terms of putting some additional content up on the channel. So that's what today is about. Some practice questions on equity securities on your SIE. The answer sets are more important actually than the questions. So these answer sets are what I want you to be familiar with on your exam. If you find this helpful, let me know, and I'll continue on with another installment with some practice question on debt securities. These aren't designed to give you some kind of a green light or, to go to the exam. They're just practice questions for you to get comfortable with answer sets. So let's get started. Let's get started on these practice questions on equity securities. The maximum number of shares a corporation may issue under terms of its charter can best be described as, and again, it's this answer set I want you to be comfortable with. The answer set. The first thing we're going to do in this form is go to an attorney and get a corporate charter. And in that corporate charter, we're going to stipulate the maximum number of shares we can issue, which is the authorized stock. So, may we authorize 5 million shares that can be issued, authorized stock, authorized shares. So the answer here is A. Now, the other wrong answers for people who write tests are called distractors, and they could have been the right answer to a different question. The answer to this question, in fact, let me get out my annotation tool here so we get a different color. So the answer is A. Now, it could have been a different answer depending on what we're asking you. Now, again, what I've done is rotate answer sets here. The shares of a corporation that have been placed with investors, I should say with investors. Let me fix that on the fly here. Placed with investors. There we go. Can best be described as the issued stock. That's the stock. Whoa. Sorry about that. That's issued stock. So maybe we authorize, in my example, maybe we authorize 4 million shares and we choose to issue 2 million shares. All right, that would be, let me get a different color here, bigger highlighter. Boom. Issued stock. And if we had 4 million shares authorized and we'd issued 2 million shares, well, that means we'd have 2 million shares that were authorized but on issue. Again, more about the answer sets and the actual answers, right? So, we associate corporations that have excess cash, more cash than they need in retained earnings to build the business, mature, stable companies, to try and return excess capital to their shareholders or owners. And the way we typically do that is through buying stock into the Treasury. So in my example, we had authorized 4 million shares. This is not a lecture. This is just practice questions. I will link my equity lecture in the comment box and in the video description with the timestamp so you can find that entire lecture. These are practice questions and it's the answer sets I'm most interested in sharing with you. But in my example, we had 4 million shares authorized and we'd issued 2 million. Maybe we go back into the marketplace and buy 200,000 shares. And that would be called Treasury stock. And I would definitely know that Treasury stock has no voting rights and pays no dividends. I would definitely know that. Now, sometimes the corporation can either do that through a brokerage firm in the secondary market, or they can make a tender to their existing shareholders. They can just go to their existing shareholders and say, hey, would you like to tender your shares back to the corporation for X? And then you as a shareholder would decide whether you want to accept that tender or not. The shares of a corporation that have been issued, reduced by the number of shares that have been retired, can best be described as outstanding. Now here I'm trying to just use language that doesn't give it away. So, if I wasn't trying to give away the answer set, I would have simply just said issued less Treasury. But here I'm trying to avoid, using that language. So that would be outstanding. So my example, we had 4 million shares authorized. We'd issued 2. We had 2 million shares that we had placed with investors. We bought about 200,000 shares. That would be 1,000,008. 1,000,008. Which of the following has voting rights? You should definitely know that preferred stock doesn't have voting rights. You should know that common stock has voting rights. Shares vote, not people. So, that's important. It's not the shareholders that are voting. It's the shares that vote. Preferred stock doesn't vote. Rights doesn't vote. Warrants don't vote. I thought this was pretty solid of Mr. Buffett. Mr. Buffett, Berkshire Hathaway had 700 million warrants to buy Bank of America common. And they were asking about a shareholder vote. And he said, well, my warrants don't vote. But when I convert it into the stock, which I'm going to, we will have 700 million shares of Bank of America, and that will be voting with management. So he didn't have to say that, but it made the point to tell you that the warrants don't vote. The common stock votes. Which of the following has a fixed or stated rate of return? That would be a preferred stock. And, that's stated as typically, let me get my annotation tool out here. It's very important on the exam that if I tell you this is a 6% preferred, for example, let me get a larger font here, that that that's based on par. You should definitely know par in a preferred stock is $100. It's an arbitrary number we use to set up the books. And if I tell you on the test, this is a 6% preferred stock, you should be able on the test to tell me that what that means in dollars is that we could expect to receive $6 annually. Be careful, $6 annually. And so that means we are going to be receiving $1.50 quarterly. Right. So make sure you you have an understanding of that for your SIE exam. Most of the SIE exam, by the way, is recognition. Very few practical application, very few judgment questions. Which of the following is short-term and at issuance exercisable below the current market price? You definitely have to, on the test, be able to contrast rights with warrants. You definitely have to be on the test, be able to contrast rights with warrants. You should definitely know that rights are short-term and exercisable below the current market price. The existing shareholders of a corporation have a right to maintain their proportionate ownership. That's called the preemptive right. And the mechanism used for that is called a rights offering. And so in my example, we had 4 million shares authorized, 2 million shares issued. Let's assume we didn't have any Treasury stock. Let's further assume that Dean owns 200,000 shares of the 2 million. So I'm a 10% stockholder. And if they go to the issue of their 2 million and I don't buy any, I'm going to own 200,000 of 4 million. I'm going to get diluted. My proportion ownership is going to go down from 10% to 5%. And so I have the first right of refusal, all of us, by the way, existing shareholders, even if you have 100 shares, we have the first right of refusal on the issuance of the new shares. Now that's going to take some money. They can ask us politely about what we'd like to do, participate or not. But that's called a rights offering. And the rights are the only ones, by the way, that at issuance are below the current market price, always. As I said, what you got to be able to do is contrast that with warrants. Now, here in the practice questions for equity securities, I'm not rotating it's not as random because I want you to get comfortable with the answer sets. And I want you to be comfortable with what you're being asked to do as a test taker, right? As I mentioned, what you have to be able to do on your exam is contrast rights with warrants. Warrants are a test question long-term and at issuance are exercisable above the current market price, right? So when Mr. Buffett, Berkshire Hathaway, received 700 million warrants in 2010 to buy Bank of America at $7.15. At the time, Bank of America was $6. But that was out to the year 2020, 10 years, for the next 10 years. They could buy Bank of America for $7.15. 5 years in, 2015, Mr. Buffett exercised those warrants and received the 700 million shares of Bank of America common. So, by the way, the warrants were a sweetener to get Mr. Buffett, Berkshire Hathaway, to buy the preferred stock in Bank of America in 2010. So warrants are typically used as a sweetener in either bond or preferred stock offering. And I have a practice question for that coming up. There we go, right? So which of the following is most likely used as a sweetener in a bond or preferred stock underwriting? It makes it easier to sell the preferred stock or the bonds if we actually have some warrants and say, hey, I have a sweetener for you. I have a sweetener for you. You know, these are called units. A unit is more than one security offered together. So I say, listen, I'd like you to buy some bonds, but the bonds come with some warrants. I'd like you to buy some preferred stock. The preferred stock comes with some warrants. Very testable to know who comes where in liquidation. And the most junior claim in liquidation is the common stock. I would be prepared on your exam to know senior to junior. I'm just doing equity securities here, but if I'd asked you to know senior claim, it would have been A. This is just on equity securities. So in this practice question set, the answer is never going to be a debt security. Being nice, that's not true on the actual exam, right? So these are practice questions about equity securities. Which is the most senior equity security? Be careful. I didn't say what is the most senior security. I said, what is the most senior equity security? And you should definitely know that preferred stock is senior to the common. It's called preferred stock because we have preferential treatment in two areas, liquidation and dividends. The corporation can't pay a dividend to common if it's arrears of the preferred stockholders. And if we do liquidate, the preferred stockholders come ahead of the common. Which of the following has limited liability? Now, I don't expect at this stage in your study effort or doing these practice questions that you know A, B, or D, but short stock exposes customers to unlimited risk. Agreeing to sell stock you don't own and uncovered or naked call exposes you to unlimited risk. When you own the stock, it only can go to zero. There's no such thing as a stock at -5. Now, again, I just had to come up with some distractors, some wrong answers here. The takeaway is not so much do you know that short stock exposes you to unlimited risk, a naked call exposes you to unlimited risk. If somebody asks you to serve as a general partner in a partnership, you say, wow, am I exposed to unlimited risk? I say, indeed you are. But my test question isn't here trying to get you to understand A, B, or D. The takeaway is to know that stock in a corporation has limited liability as where other investments do not. Right? So that's kind of a comforting thought to know your stock can only go to zero. It can only go to zero. What we're hinting at is we have things that can go past zero. Stock owned by the officers, directors, and principal stockholders can best be described as control stock. And we actually call these people control persons. So control a stock and control persons is a definition we use when discussing these types of folks. Now, they either got the stock directly from the issuer. And if they got it directly from the issuer, that stock is going to be said to be restricted stock, restricted in terms of its transfer, restricted. Sometimes we say unregistered stock because it hasn't gone through the registration process. In the old days, there would be red letters that say stop transfer, right? Or a legend. And so there's a lot of, colloquial terms for the stock that control persons got directly from the issuer. Now, they might also have stock that they just bought in the open market. The stock they bought, if they go into the open market and buy that stock, it's New York or NASDAQ, that's registered stock, and no problem. Registered stock, there's not going to be a holding period. There is no restriction on that stock in terms of a holding period. Be careful what Dean just said there in terms of a holding period. And here I'm hinting that in this red letter stock, this stock over here, we have a holding period. So a different question really, but we're just talking about control persons, and they either going to have restricted stock or unrestricted. If it's restricted stock, there's going to be a holding period of 6 months before they could even sell it, even if they wanted to, right? So this holding period here is going to be for stock that you get directly from the issuer. And that's unregistered stock, and it's going to have a 6-month hold. By the way, that would be true even if you're not a control person, right? And the rule that speaks to this is called, very important, Rule 144, right? So you're going to expect to be tested on control stock and control persons and volume limitations and restrictions based on this 144. Again, this is not a lecture. This is an explication of some practice questions. So just in your taking notes, I told you I'll link to my equity lecture, which is a narrative lecture, and it has practice questions in it, and I highly recommend it, no surprise. But if you're taking notes and you're watching the explication that we're doing, just make a note to yourself, make sure you understand 144. Well, here we go, right? Under Rule 144, which stock is subject to volume limitations? So regardless of how these insiders got the stock, regardless of how those control persons got the stock, they're always going to be subject to the volume limitations. I think a good way to remember it is 144. So they're going to file the form 144, form 144. And that form is going to be good for 90 days. So you got to find out at or prior or no later than concurrently. And what you can sell is 1% of the outstanding stock or the average of the last 4 weeks trading volume, whichever is greater. And again, we're not, doing lectures here. We're just getting you comfortable with, we hope, the answer sets that you may encounter on your exam. I can't imagine any draw of your exam in which you're not going to get a question about American depository receipts, ADRs. All the following are true of American depository receipts, except ADRs facilitate U.S. investors owning foreign securities. That is indeed true. Looking for something that's false. The foreign securities are held in the foreign branch of U.S. bank. That is true. The dividend distributions are received in U.S. dollars. That is true. ADRs do not have currency risk, and they most certainly do. They most certainly do, because before they distribute the dividends to the ADR holders in cash, it has to be converted. So if you own Telefonos de Mexico as an ADR, they're going to turn pesos into dollars. If you own Nestle, a Swiss company, they're going to turn the Swiss francs into dollars. If you own Samsung, a Korean company, they're going to turn the won into dollars. If you own Toyota as an ADR, Japanese, they're going to turn yen into dollars. So the danger you have is that the peso, I'll use the peso, used to take 10 pesos to get a buck. Now it takes 20 pesos to get a buck, and your dividend got cut in half. So ADRs certainly do indeed have currency risk. Very testable, high probability. Can't imagine any draw in which you don't get asked about an ADR. A convertible preferred stock has a conversion price of 20. It is very, very important that you know when given the conversion price, you have to establish the conversion ratio. And so once again, it's very important for you to know that par in preferred stocks is 100. That's the arbitrary number we use to set up the books and move forward in terms of discussing, preferred stocks. And the way you're going to establish the conversion ratio is you're going to divide that by the conversion price, which in this case is $20. And when you do that, you get 5 shares. And so that would be the answer. Let's see if that answer is available to us. Boom. Yeah, there we go. So it's choice. Let me get my choice B. I have a whole lecture on convertibles. I think it's a little overkill. I don't put it in I don't have it in the SIE playlist because I don't think on SIE you're going to have to calculate parity or do any of that. But there's a separate lecture on convertibles if you want to watch it. Now, if the SIE, I'm so happy, by the way. So thank you so much. We are now getting a lot of SIE people into the channel on the first leg of their testing journey rather than the second leg. And I'm very proud of our SIE playlist. It will have 43 videos, I think. But always tough to decide, how much stuff to put in there. Now, if you're going on to a Series 7, there's a lot of overlap, and you can't possibly put too much work into your SIE study effort, because the execution of your SIE study effort will pay huge dividends if the next leg of your testing journey is the Series 7. I would even tell you, if the next leg of your testing journey is a Series 6, please put in as much effort on your SIE as possible. I think if you really put in a solid effort on the SIE, you could almost pass out of the Series 6 top off. So just, try and suck it up. We're looking for a pass, but make sure you understand you're laying the base for, going for what I call the hat trick, where you can get all three of your test taking and registrations done, 3-0 is what we're wishing for, right? So again, I put this in here because I think you should be able to do the conversion as a minimum conversion ratio. Maybe parity, very low probability in SIE, 7 guaranteed. Which style of voting in a corporation protects minority shareholders? Now, regular way voting and statutory are basically the same thing. And that's how most corporations work. So, if I have 100 shares and we're voting on 3 board seats, I vote 100 yes, a no, 100 yes, no, 100 yes, no. Or if it's cumulative voting, then I take my 100 shares times 3 and I have 300 votes. And so having 300 votes I can put on a particular issue and load up, like board seat A, for example. The idea is that the other shareholders might disperse their votes, and so I would have a greater impact. So cumulative voting, also known as block voting, protects minority shareholders because I can put all my votes on one thing. I kind of think of like voting here. I'm coming to you from Las Vegas, Nevada. And, if we had cumulative voting, there were 10 propositions on the ballot, I could have 10 votes. And I could spend them on whatever proposition I think is important to me, 5 and 5 or 3 and 3, whatever the case may be. Again, I'll link to my equity lecture where I give you several examples of how to do this in terms of practical application. But as I said, most of the SIE is recognition. I have a couple practical application questions here for you. For example, figuring out the conversion ratio. That's practical application. Can you do some math? Here's another one, right? Corporation pays quarterly dividend of 22 cents. This is Bank of America. Bank of America pays a 22-cent quarterly dividend. Now, you got to be careful here because Dean is kind of being a jerk. So you got to say, okay, well, that 22 cents quarterly means what I'm going to get times 4 is I'm going to get as an annual dividend 84 cents. I'm terrible at arithmetic, so I'm taking my calculator. 0.22 times 4, 88 cents. Good thing I use my calculator. So that's the annual dividend. And that's what we need to have to be able to do current yield. So there we go. Boom, right? Now I'm back in business. Current yield is what it pays you divided by what it costs you. So what it pays us is 88 cents. And what it costs us is $30. And you can't be giving up practical application questions because the answer is there. You just got to figure it out. So 88 divided by 30. I come up with 2.9, 2.8. That won't be the difference in getting the question right or wrong. So I'm just shopping my answer set. And I have 2.9. And the closest answer I have for that available to me is B, 2.8, right? Again, the difference there between, rounding up by 1 basis point is not going to be the difference. So 2.8. I'll tell you what I'll do because I'll probably use this at some future time and place. So I'll just fix it for future test takers. Because my game plan is probably if you guys give me the thumbs up on moving forward and doing practice questions for debt securities, what I'll probably do is make them more difficult and randomize them when I get all done and come up with another practice test. My practice tests are much tougher than this. So there are 3 on the channel. There's one I did practice final. There's the FINRA practice final. There's a Test Geek practice final. And there's a Kaplan practice final. So we have 4 practice finals. This isn't a practice final. These are just practice questions. But anyways, let me just fix this real quick. And I'll just take care of that. Boom. And the answer is B, 2.9. A corporation has a 5-for-4 stock split. A customer owns 400 shares would receive how many additional shares? How many additional shares? So there's a lot of ways to do this. What I recommend is you take your calculator, and you take 5 divided by 4. That's the ratio, and I get 1.25. Then I would times that by my position, which in this case is 400 shares, and then I get 500 shares. Now be careful. I didn't ask you how many shares would your client have? I asked how many additional shares would your client get? And so again, let me just show that to you. What we're going to do is we're taking 5 divide by 4, and that gives us 1.25. And then we're timesing that by whatever the share position of the question is, which in this case is 400 shares. And when we do that math, we get 500 shares. That's, again, if you just do that math, that's 500 shares. And then we just got to be careful what they're asking us. You guys remember what they're asking here is not the new position. It's how much is the, how many additional shares did we get? So the answer here is B, 100 shares. By the way, I would also know that stock dividends and stock splits are not a taxable event. You know, cash dividends are. So in our previous example, let me just clear this up. That 22 cents you're getting quarterly, 88 cents that you're getting annually is taxable. It is taxable. And so cash dividends are taxable, stock splits are not. All right, well, I hope you found that helpful. Remember that inch by inch, your SIE test is a cinch. Yard by yard, your SIE test is hard. And let me know if you found these practice questions helpful, because if the answer is yes, you can expect another installment with debt securities practice questions. And if the answer is no, well, then, you know, I won't waste my time or yours. Okay, study hard, and hopefully I'll see you in a class or see you in the next installment.